so much, Eddie, and thank you everyone for having me here today. Just one line of disclaimer for everyone who has seen me present before. This is going to be a little less technical so that I can kind of handle more of a mixed audience, but I'm happy to go into detail in anything if you want me to so much do that. So the paper I'm presenting today is US capital market consequences of the Brussels effect by using evidence from sustainability reporting. And basically, what motivates the paper is there are these strategic reports that the European Council produces and sends to the Commission. So these are explicit documents where the European regulator states what the strategy for the next 50 years will be. So that is actually laid out explicitly. And one of their goals is to be first movers in global standard setting. Now, imagine what this means. It implies that the regulators think that they have the capabilities to actually impose some kind of regulation, in this case, standards, that are ultimately to regulate the whole world. This seems extremely ambitious, not something we have seen succeeding in many other areas before. We have it in the case of accounting standards, for which we have two different systems, US GAAP versus IFRS for the rest of the world. And the reason the European regulator explicitly states they can do so they can achieve this goal of being the first movers in global standard setting, is because of this notion of the Brussels effect, which is something that has been getting a lot of traction in the media related to various relations that I will cover in a minute. So what's this Brussels effect? This is the idea, it's also an idea that was raised by Columbia law scholar Bradford, that basically states Europe has the ability to impose regulation beyond its jurisdiction, so that the jurisdiction that is passed by the regulators in Europe can extend beyond the borders. And the way she claims this is achievable, or the channels through which she claims this happens, are one would be the firm-driven channel, which is basically internal efficiency. So think the case of an American company that has operations in Europe, has also operations in Australia. Well, if I have to update some of my operations in Europe because of a new regulation, it might make sense for me to also change my operations in Australia. There's synergies, internal synergies, there's economies of scale. And that's also the idea that many times we've seen the case that after Europe moves in terms of regulation, some other jurisdiction will follow the example. So if I expect Australia to follow the example of Europe at some point, it makes sense for me to actually adapt my regulations so that I have my operations, so that I have a first mover advantage once Australia regulates on the same slide. Then the other channel through which this would work is the regulator-driven channel. This is more of what I will be interested in and what I will be covering today, which is the idea that the regulator becomes explicit in their ambition to regulate the world. So following this kind of explicit ambition, what we start seeing recently is examples of regulatory frameworks where Europe is stating that anyone who has some level of operation that will change how that is defined depending on the actual regulation, some level of operations in Europe is expected to comply at the global level, so with the whole parent organization. And if they don't, then fines will be proportional, depending on which regulation we're talking about, to be proportional to global revenue, so a percentage of global revenue, which might end up being quite significant. So examples of this could be, for example, the GDPR, so General Data Protection Regulation. So the idea that any company that handles substantial data from European residents will have to comply not just with their subsidiaries in Europe, but with the whole operations will have to comply with the regulation. And in this case, we have a little bit of ambiguity on the language, because basically, what do we mean by substantial data from European regulators? Well, it's not exactly explicit, and it's kind of hard to identify which companies are affected and which not. And that's been part of the problem, even for companies themselves, as they were not always clear as to whether or not they were affected by the regulation at some point. So I guess in that direction would be what we see in so many other regulations when it comes to voluntary adoption, right? So before we have an actual kind of enforcement that you have to comply no matter what. You have some level of voluntary receipt in the case of disclosure, for example, where there may be benefits for investors that eventually lead managers to act in that direction. In that sense, at that level, it needn't be different from other kind of regulations, except for maybe the one minor difference is that the idea that once Europe regulates, other jurisdictions tend to follow, which is not the case for all kind of regulators. Right? It's usually Europe. We've seen examples where they tend to be more stringent in regulation, and therefore others tend to be more example. So it would be more expected to be seen in a case like European regulating first and then other jurisdictions following that in other kind of stuff. Artificial Intelligence Act, and the third one with the same kind of ambition would be the CSRD, the Corporate Sustainability Reporting Directive. And now my question is exactly yours, Marcel. It's fantastic. Europe wants to regulate the world. They want to implement that. They are actually drafting regulation with that intention. And the question is what you just asked. Is this credible? Can they actually do it? Right? And of course, credibility cannot be observed. So one thing we can do instead is ask whether or not investors are pricing it in. So if investors are reacting to it, at least in the eyes of investors, this is credible. And that's what I tried to do in this particular paper that I'm presenting today. So to try to answer the question as to whether or not investors, US investors, believe this is credible, which again, is it legal? Is it legal? Well, there's so many layers to the question as to whether this is doable, this is legal, this is feasible. But the small piece that I try to answer is if this is being priced in, then it means that this some stakeholders that we care a lot about, which are shareholders, do believe that is the case. So for doing that, I will be exploring the setting of, so I will be conducting an event study on the days that led to the approval of the CSRD. And the reason why I'm choosing this regulation as opposed to the other two is, first of all, scope industry exposure. So basically all industries got affected. So in the case of GDPR, it's only industries that tend to handle a lot of data from European residents. In the case of the EU Artificial Intelligence Act, it's also highly tech companies that will be affected. But in the case of the CSRD, it will be all industries. So we have a setting where all companies are expected to be affected at some level if exposed to the regulation. The other thing that is quite unique, at least it's different from the other two regulations and makes this interesting from a research point of view, is that we have very clear identification of which companies have to report. So I was mentioning before, in the case of the GDPR, companies who have to report are those who handle significant data. How do we actually define that? I mean, we can tell some companies for sure will have to report. Some companies handle zero data, so they will not have to report. What happens to all the companies in between? But in this case, we actually have very explicit thresholds, and that will allow us to run some level of analysis. Now, what's interesting about those thresholds is that in this case, it's not based on aggregated business. So this is not the typical case of a regulation that affects all the large players and does not affect all the small players, in which case we would have a lot of correlation with a lot of other things happening at the same time, which is usually the case of many of these types of regulations. In this case, the thresholds are not defined based on aggregated business, but on the size of each individual subsidiary. So I might be a US company who has one single subsidiary in Europe. And because that single subsidiary is above the regulatory threshold, I have to report under the CSRD for my whole global operations. Whereas I might be an American company with tons of subsidiaries in Europe, all of which are small enough that none of them individually triggers reporting criteria, and then I do not have to report under the CSRD. This creates kind of an interesting set of variation, creating two samples of American companies which have exposure to European regulation, some of which will be directly affected by the CSRD. So those would be the American companies who have at least one subsidiary that met the reporting threshold and therefore will have to report under the CSRD, and some of which will be below that reporting threshold. So that will create a direct and an indirect exposure composed of samples of companies, both of which have subsidiaries in Europe and regardless of what their aggregated business in Europe is. I stopped my analysis after the regulation was approved. So Omnibus, for those of you who are not familiar with the CSRD, basically at some point, so actually last year, February last year, 2025, the different institutions in Europe decided to come back on CSRD and to reduce both affected companies, so which companies would be on which sample, as well as the scope of reporting requirements. That hasn't been fully approved yet to the last thing I know. I know that a couple of months ago, Parliament said no to Omnibus, so we were back to the full sample.
It has approved.
It has approved?
Maybe 2 weeks ago.
Okay. So now it's been approved. So basically they're shrinking, which are the affected companies and the reporting requirements for those companies. Now there's a couple of reasons why I didn't include it on the analysis. I would say 3. One is obvious, we were still going, as you can tell. So we only got approved 2 weeks ago. The other thing is clearly after the new administration in the US takes over last year, the trade dynamics between the US and Europe clearly changed. So it's hard to say whether any analysis conducted before that will be comparable to any analysis conducted after that in terms of the interpretation of the results. But the most important thing why I don't include it is because since the regulation was already approved, so companies thought they had to comply. And after it was approved, after we were already in the enforcement window, then they started retrieving it. So the extent to which companies have already started complying with the CSRD is unobservable. And then any kind of investor reaction, I don't know if they're reacting to Omnibus per se, or they are reacting to the fact that the company was at various level of enforcement at the time. The whole idea why this is material in an extent that goes beyond just compliance with a regulation, which is what I'm trying to do here. I'm not just looking at compliance, I'm not just looking at the cash flow effect that we would expect from any kind of regulation like this one. If this, to some extent, is also affecting the risk profile of organizations, it implies that this is more than just CSRD per se. So to the extent that this is just a proxy, and companies are reacting to something broader, like would be the notion of the Russell's effect, it implies that they believe, investors believe that to a certain degree, there's more regulations coming in the line of carbon neutrality. There's more regulation coming in other scopes related to a social normative agenda, like transparency, like data privacy, that is also getting their firms are also exposed to that. So my reading of this analysis is that what investors are reacting to, it's a little more broader than just systems. Okay.
I mean, at some level, what's nice, so this setting is capturing this idea of moving towards a Russell's effect. And you can almost extrapolate that and think of, right, there could be a shift, a regulatory shift where you move away from Russell's effect, which is this retrenchment that we're talking about with the omnibus, right? And I like the idea of just thinking about how this is just a general proxy to capture any types of extra jurisdictional regulation. As a company, when you think about what you're going to be picking up with your market responses, investors probably are still thinking that, well, there may be a piece that's unique to European Union Brussels. More broadly, this is an idea about, I'm worried about as an investor in this company, what is this company exposed to if there's a Sydney effect or a Beijing effect or any other effect that pulls my company and makes me do things, regulatory obligations that maybe I wasn't anticipating.
Yeah, absolutely. I think in a way, what this is about the Brussels effect, but the generalizability of the concept would be towards global regulatory complexity to which global companies are getting exposed, right? And again, for that you need 2 things. You need regulation to be written with that intent, and then you need some mechanisms that will allow that to be credible and enforceable. So those are the 2 elements that I think are quite clear. And similar things. So this is not just about the international arena. We can also think of the case of the California effect, for example, in the case of the US, where you see a similar dynamic in many ways. Possibly companies are exposed to Europe in a different way that they're exposed to California, depending on the industry. But you see similar dynamics that could be very. Okay, so basically, keeping this at a very high level, the two predictions that I tried to study in this paper are as to whether there's a negative investor reactor to each of these two samples. So we have the sample of companies, of American companies with subsidiaries in Europe, whose subsidiaries are subject to the CSRD, triggering compliance at the whole parent organization. And then we have the sample of American companies, which also have subsidiaries in Europe, but whose subsidiaries are not exposed to the CSRD, and therefore they do not have to report directly.
Sorry, for both groups, do you have a sense, if any, how many companies were already either compliant or like, maybe wasn't on the right formatting, but basically were already doing what was required? How common was compliance with the CSRD before it became required?
So that's a great question. What I do run is an analysis of ex-ante disclosure. So the thing with the CSRD is this is not just ESG disclosure. This is a lot of very complex ESG disclosure. So there were some levels of ex-ante disclosure. So companies were already disclosing materials on ESG to various degrees. And what I do is an analysis where I actually look at various levels of disclosure. So whether they were disclosing before this any kind of qualitative data. Then I also assess whether they were disclosing some level of scope 1 quantitative data. So scope 1 would basically refer to emissions directly emitted by the company in their operations. And affects particularly, for example, utility companies. Then scope 2 would be emissions that go through purchase of electricity, so that are indirectly required for running their operations. And then scope 3, which is the big thing that is coming with the CSRD, which was not included before this, at least in a very strong regulatory way, refers to the emissions related to your whole value chain. So all your suppliers, all your clients. So I even test scope 3. So whether companies were making some level of effort to report some level of data on scope 3 before. I don't find any evidence for those companies that have to report. I do find some evidence for companies who do not have to report of ex-ante non-disclosure being actually significant for industry reaction, which implies, but there's two things that happens here at the same time. One is they were already disclosing to some point, so they're not as affected, maybe. But the other thing is, this is an event study, so I only get to capture any change in investor reaction on these specific days. And it's possible that investors are already wading into prices way before my selection of events, anything that had to do with disclosure. So ex-ante disclosure behavior was already present. The other thing is, what I have is binary variables, where they're disclosing something, yes or not. Is that credible? Is that, is that data quality data? CSRD even came with requirements for auditing data, so which we never had before for ESG, at least at a international kind of level. So all of these things eventually haven't. Yeah, it's hard to convince people that that was feasible. And basically, the reason is because CSRD is such a monster of a regulation that it's so complex that it seems to affect everyone negatively to different degrees. So what it's going to affect is relative to others, but there's not net winners, let's say, of the regulation. That's an art for sure. Yeah. And first of all, direct and indirect exposure clearly, another one is sometimes if I'm getting results, it implies my benchmark companies are not using to the same degree, or else I will not get any kind of results. And then I will also see, so the last cross-sectional that I ran is seeing companies who have flexibility to retreat from Europe, and they seem to me, I have evidence that they are losing less than everyone else. So investors like flexibility, it's but it seems everyone is losing, but not specific.
Question. So given it's a US study, I guess you don't really have to exclude everything from shareholder voice, right? Like that wouldn't come into the impact.
From shareholder voice?
Yes.
I mean, given that I'm conducting what you say, the event study, this is on the specific days. So the reaction to the events would be independent of what the race involved in. But yeah, it's something worth considering, assessing whether or not at some point to as an extra analysis to test again that this is material and the investors really care about this. That would be the staggered part is there were conversations about it, but it was affecting everything. At some point, they decided to affect different companies at different stages, but the staggered dimension of the adoption changed over time. So it's not the case of, okay, from the very beginning, different sets of companies were had very clear different sets of mandates. Also because a big part of while everything is so interconnected is basically to the extent that companies have to report on the scope 3 of someone else, it implies that in this interconnected economy, everyone is a client or a supplier to someone else. So even if I don't have to create the reports for myself, I have to report later, and that's what will motivate the second sample, right? I still have to produce numbers for those who have to report. So I'm either affected directly from the first day, or I'm already getting affected indirectly at some level. So flexibility, that's part of the real effects, and it's part of what I want to look at next, is the real effects of how companies reacted in terms of managing of their subsidiary network. And what's going to be different is that not all subsidiaries are created equal. So it's not the same if I have a subsidiary for the sake of intellectual property or taxes, that if I have a factory that is a key part of my supply chain, basically. So that is the kind of thing that we'll have in a follow-up study. But basically, why would I expect any kind of effect for the sample of companies directly affected by the CSRD? There is one line that is obvious here, which is the cost of compliance and monitoring of not just my company, but my whole supply chain. So obviously, if I have to report, there's money coming out of me for the sake of reporting. So of course, investors have to value the fact that money will come out of the company because they have to pay. There is a cost associated with compliance. But what I'm more interested about, and what I think it's interesting is, of course, we expect that, and that will happen for sure. But the additional question is, will there also be some level of risk reaction from the side of investors? So are investors also pricing some level of risk that goes on top of that cost of compliance and has to do, for example, with the EU goal of carbon neutrality? So we know CSRD is just one regulation in a bunch of set of regulations that are escalating towards the idea of achieving carbon neutrality by year 2050. So at this point, for example, companies do not have to change their behavior. So if I have a lot of emissions, I'm not getting penalized by CSRD specifically. However, this is very likely one regulation in a step function of regulations that will potentially lead towards that kind of regulations where if you have above a certain level of emissions, you will be penalized, and you will be, once you report, one regulator have your data, this will likely push you in the direction of potentially eliminating all kinds of emissions. So in that way, the company is exposed to the cost of compliance with this CSRD, but it's also exposed to the risk of that additional regulation that will come following this one. The other thing is, this is not just about carbon neutrality. So it seems to be the case that Europe at this stage is regulating some level of social normative agenda. So in the past, take the example of the UK and the anti-bribery provisions. We've already seen cases where companies or regulators were trying to regulate beyond their borders, but for things that were what we call left tail. So things we all agree are wrong. Anti-money laundering, so money laundering, corruption, murder, right? There are some things we could all agree that are wrong. And regulators in the past have gone in the direction of trying to impose some level, some minimum level of fair play field. And we saw the case with the UK, we saw the case also with the US and the Foreign Corruption Practices Act, for example. However, this seems to be something different. So the EU seems to be defining what the new set of values are. So these are new social values that seem to be set: sustainability, transparency, data privacy, for which maybe there is not yet global consensus as to whether or not this should be something everyone should comply with. And this is the kind of regulation that is coming in this direction. And so far, we have 3 examples. So we have CSRD and all the regulations that try to achieve carbon neutrality. We have also GDPR, so data privacy, and we have EU Artificial Intelligence Act. What will be next? We don't know. So companies and investors also have to hedge for the fact that new values are being developed, and we don't know what the next one will be. But these companies are exposed to that risk as well. I have to produce my numbers. So I'm getting an exposure to a regulation to which I'm not subject to comply with directly. So there is this level of indirect exposure that is making me produce numbers and have to comply, even though I'm not affected directly by it. The other thing is regulatory contagion. So basically the idea here is that to the extent that Europe is regulation, it's more likely that Australia will regulate. We actually saw the case with the SEC rule. So the SEC seemed at some point to follow the example in Europe, even though we all know how that ended up turning out. But to some level, there was even in the US some level of regulatory contagion. So basically, it seems to be the case that if Europe regulates in one direction, the likelihood, the probability of everyone else regulating in that same direction increases. And this is something that investors also need to assess. The third thing is the fact that these are companies which have subsidiaries in Europe. So even though today's thresholds are not affecting these operations, there's nothing saying that the next regulation will be, for example, based on the size of each subsidiary as opposed to aggregated business. If this was based on aggregated business, I can tell you I would not have two samples. There would be one single sample because everyone is aggregated business is large enough that they would be affected by the regulation. So CSRD is based on, thresholds are based on the size of each subsidiary. Will the next regulation about the next step in the EU Green Deal, the next step towards carbon neutrality, will also based on the same thresholds? There's no guarantee. So that is part of also of the risk that investors need to incorporate and include into their pricing. And the reason why I also expect an investor reaction to this second sample. So keeping this very brief, but basically, which from an accounting literature point of view, where would this paper fit? I'm basically speaking to two streams of literature. One which reflects to cross-border regulation, which could be the case, for example, of the IFRS, cross listings, the UK anti-bribery regulations, or the FCPA from the side of the US. And I'm also speaking to non-financial reporting, and in particular to capital markets reaction to non-financial reporting. What makes my paper different from this, from the papers that have been so far published in these two areas, would be the fact that, first of all, in this case, I'm binding the two, so I'm speaking to the cross-border nature of a non-financial reporting regulation. But the most important thing is, in this case, so usually when we see regulations that have to do with disclosure, they're speaking in spirit with the idea of increasing the efficiency of capital markets. So usually when we see a disclosure regulation, the expectation is, well, we are trying to decrease information asymmetry, because by reducing information asymmetry, we're basically making everything better for shareholders. They have better information about where they are putting their money, and because of that, cost of equity for companies decreases, so everyone wins. So that is the kind of thing we usually see with disclosure, where there is an intent to decrease information asymmetry. So if that is the case, and we're looking at a case of cross-border regulation, the expectation would be, well, we're coming from a high scrutiny jurisdiction, trying to make some place that seems to be more opaque, more transparent. But that's not the case with the CSRD, and in particular what I'm exploring here is the case of a high scrutiny regulator and environment, like it is the case of the EU, trying to impose regulation on another place where we have a very strong information environment. So where information asymmetry is not a problem per se. And the most important thing is, in this case, it doesn't seem to be about reducing information asymmetry. CSRD does not seem to be the case of a regulation trying to improve the efficiency of capital markets, but rather to follow the direction of pursuing some other kind of social welfare, trying to benefit other stakeholders. So it doesn't seem to be a disclosure regulation related to making things better for shareholders, but for someone else. And in that regard, this seems to be quite different from what we've seen in the past, basically. Okay, so I will not get super technical here, but just at a very high level of how I do this, basically, what I'm trying to look at is the investor reaction to the Brussels effect. This is the theory. At a construct level, what I'm trying to answer, the big question I'm trying to answer is this. And then when we put it back into the real world and what we can actually study at the proxy level, what I'm doing is looking at events leading to the approval of the CSRD and seeing the short window stock and option price reaction in those events, which will allow me to interpret what will be the relationship between the investor reaction and the Brussels. So when we look at the short window reactions, of course, the one key metric we care about is abnormal returns. So any kind of investor reaction that deviates from the expectation. So therefore, we understand that in this case, the reaction is capturing the new information that was released in those events or in those specific days. And when you go deeper into what abnormal returns are, in the end, they're nothing but fluctuations in the prices of stock. So it's changes and movements in prices, basically. Now, if I want to go one step deeper, and I want to do a super simple kind of valuation model, I want to know how the price of a stock is created, then that would be a measure of some level of cash flow divided by some level of discount rate. No, super simplified valuation model. So of course, I will expect some level of cash flow getting affected by the regulation. We already discussed this because there is a cost of compliance. So there is for sure some level of cash flow that is ultimately affecting CAR. But that is not mutually exclusive with the possibility of also seeing some level of discount rate also ultimately affecting CAR. So the idea is I will be looking at results. I will be seeing some effects in terms of abnormal returns, but that can be driven by cash flow, discount rate, or a combination of the two, which is what I will argue is the case here. Now, if I am to convince you that the discount rate is truly getting affected, that investors are truly valuing this regulatory risk, then two things should happen simultaneously. First of all, of course, risk should go up. Right? So if discount rate is actually getting priced in these events because of the new information investors have that speak to the risk profile of the organization, then of course risk should go up. And at the same time, I should expect uncertainty of risk, which basically measures how confident investors are on where the distribution, the risk profile of each organization is. So what is the risk profile of this specific organization should go down. Meaning, if risk goes up and uncertainty of risk simultaneously goes down, it implies that as an investor, I am now more confident about what the risk profile of this organization is, and that risk profile is up because of this new regulation that it's out in Europe. So this is what I will be trying to do here. And I will not be getting into all the details of the measures, but I just want to give you a super high level intuition of what the key metrics here are doing. So we have stock return volatility that I will assume we're more familiar with. But in terms of Colpute skewness, think of this as basically, if in general we expect investors to be optimistic, so this measure should basically be positive in general, meaning investors do think that maybe something weird can happen and give them a lot of money. However, when something that actually goes in the opposite direction happens and investors become more aware of the fact that something could go wrong, then this measure gets dominated in an exceptional way by the put, and in which way this measure will be negative. And that's not usually the case, so it's only in the presence of a shock that we would expect to see that, and that would imply that we would have a negative call put skewness. Then basically we have the variance risk premia. This measures forward-looking volatility versus past-looking volatility. This behaves very similar to abnormal returns in that in the absence of a shock, these two would be equal, so the value would be 0. So if this value is not 0, it implies there is a change on forward versus past-looking volatility, and the sign of the change will tell us what the output is in terms of uncertainty risk. A kind of sanity check will be the delta of the implied volatility. So this is only looking at the forward-looking volatility. in the short window and seeing whether there is some level of step function here that will tell us that indeed there is something happening at the forward-looking volatility. And this is the previous measure was not just driven by the past looking volatility. But yes, and again, I'm using options basically because kind of any decomposition would imply annual data, which I would lose identification. So that's the choice of setting is the choice of identification strategy is just responding to that. So basically, I have a selection of events. It's a systematic search of all the events where the regulation, the likelihood of the regulation getting passed changed because it was approved at different instances in the European institutions, or when new information was made available to the public, in particular to investors, in regards to what the CSRD would include. And I only exclude the events where there were main funds potentially biasing my results. Basically, those were literally the day when Russia invaded Ukraine. It was the day the EU Artificial Intelligence Act was approved, which was only a rumor day for the CSRD. And then also the day that Israel attacked Gaza following the Hamas attack on Israel a few days before. So outside of that, all events are included. And basically, I get 2 samples for my direct and indirect analysis. And what's interesting about these samples is that they are quite equally distributed when it comes to industry representation. So basically, the 5 most represented industries in the vertical sample will be the same 5 more represented industries in the lateral sample. So there is nothing in regards to the 2 samples that hints to the idea that maybe there are different kind of industries, and that's what's giving similar or different kind of results. And just jumping into the main results. So I'm gonna just jump to the straight to the main results, but I'm happy to discuss in more detail anything if anyone wants me to. But the main results basically speak to the idea that for the vertical sample, so again, the companies most directly affected by the CSRD, there is a decrease of roughly 50 basis points on the days that led to the approval of the CSRD. And it seems to be the case that indeed risk is going up and uncertainty of risk is going down. So basically, metrics seems to be consistent. This is aggregating all 5 events. So here we're looking at the multivariate with fixed effects and aggregating all events. It seems to be the case that indeed there is an effect at the abnormal return level, at the economic level, and at least to some level, it seems to be explained by a discount rate story. If we want to look to abnormal returns, how this would look graphically, we see that abnormal returns seem to be aggregated on the days of the event. So there seems to be something systematic and unique about event days that is actually behaving different from the normal, which would be close to 0 abnormal returns. If I go to the lateral sample, I see a very similar reaction in terms of economic effects. So abnormal returns will actually be 54 basis points, which will be a little stronger actually than the vertical sample. Risk metrics will be higher, but not as strongly as in the case of the vertical sample, which makes sense. Of course, these companies are also exposed in terms of risk, but not as much as the vertical sample. And uncertainty risk seems also to be going down quite sharply. Now, I will have an explanation that goes to the cash flow metrics as to why I'm seeing a similar economic effect here. My explanation is that at least the evidence that I could collect and the empirical analysis that I run seems to be consistent with the idea that the mix between cash flow and discount rate is different for the 2 samples. It's very likely that investors were not expecting these companies to be so exposed in terms of compliance with the CSRD. They do not have to report, but they have to build reports for someone else. So they still have to produce reports, they still have to spend money, which likely was not priced in by investors before, and that will be consistent with the ex-ante disclosure analysis as Susan raised before. So in terms of graphical results, they will be quite similar to the vertical sample. And then when we look at the cross-sectional partitions, the rationale for why I'm running a specific selection of cross-sectional partitions, first of all, refers to total emissions. So the idea is, again, CSRD is about disclosure. I do not get penalized if I have high emissions. But to the extent that this is a risk story where the expectation is that following this regulation, other things will follow, making my company more exposed to that. To the extent that is true, then total emissions should be material for investors who are pricing risk in, basically, because it's not just about the CSRD, it's what's about everything else that's coming next. So to the extent that emissions matter, then total emissions should be significant. And then when I disaggregate between scope 1, 2, and 3, high scope 3 should only be material for the vertical sample. So if I have a high number of emissions in scope 3, a more complex value chain in terms of emissions, I will have to collect my numbers for all that value chain, for all those suppliers and clients that are affected to that. Whereas the scope 3 only matters for the lateral sample to the extent that when they are included in the scope 3 of someone else, they have to report. But their own scope 3 is immaterial for what investors actually give. Then ex-ante disclosure will tell me about to what extent this is cost of compliance or something that was or was not priced in beforehand by regulators. So I will be examining ex-ante disclosure, or specifically ex-ante non-disclosure. And also I will disaggregate by qualitative scope 1 and scope 3. Yeah. Finally, I will be also looking to exposure to Europe. And the rationale here is the idea that if you have low aggregated exposure to Europe, so what I will do here is I will aggregate your European sales. I will scale them by your total sales. So that tells me how much of your sales are actually happening, what percentage of your sales is happening in Europe. And then I'm going to rank all the companies based on that. So it's a ranking of companies based on their exposure, on the exposure of their sales to Europe. And then I will separate between those who have small or larger exposure to Europe in terms of ranking, and then whether or not they have to report under the CSRD. And let's just say there will be some interesting results there that I will pitch in 1 second. So basically, when we look at total emissions, it seems to be the case that total high GHG emissions are materials for both samples. So if you have high emissions, the likelihood that the next regulation will affect you and that investors care about what that means in terms of risk for that company is material, regardless of whether or not you have to report directly under the CSRD. Then when we go to scope 1, 2, and 3, we see that what's really material is scope 3 for the sample of companies who have to report. Because if they have a complex scope 3 structure, basically, then what will we require for them to comply will be more complex. So cost will be higher and risk will be higher. It's not material for the lateral sample because, again, it matters that these are in the scope 3 of these guys. Doesn't matter their own scope 3. Nothing will change if their own scope 3 is high or low. When we look at ex-ante disclosure, I find a tiny bit of evidence that ex-ante non-disclosure is only material for the lateral sample, meaning investors were likely not expecting these companies to have to disclose as much, basically, and they were expecting that if you have to report, then they were already pricing in that cost ex-ante to my event selection, but not in the case of indirect exposure. And when we go to scope, so this already captures scope, sorry, so this is material at the scope 1 level. And then finally, so for exposure to Europe, what I found is investors only see an accentuated effect if your exposure to Europe is low, and yet you still have to report. There is a disproportionate risk here. So your risk exposure is low, but your regulatory exposure is huge because you have to comply, even though your aggregated sales in Europe are a tiny bit of your global sales in terms of relative to everyone else. So for these firms, it seems to be the case that there was an accentuated effect. And so this is, it's not in the deck, but it's an online event. It's basically to your previous question, Maxime. Basically, if you're in this sample of firms, so low exposure, have to comply, and then you will see an accentuated effect. But at the same time, your total emissions for your scope 3 is also high. So a huge regulatory risk despite your sales exposure being low, then investors reacted positively to these firms relative to everyone else. Because basically it speaks to flexibility. You have flexibility to retrieve, and this is something that seems to be obviously valued by investors. So to conclude, it seems to be the case that indeed, in the days leading to the approval of CSRD, firm value decreased both for the vertical and lateral sample, as captured by a decrease in firm value of normal returns, an increase in metrics of risk, and a decrease in metrics of uncertainty of risk, as explained by the cross-sectional variations that I just described, all which seems to be consistent with a negative investor reaction to a firm's inherent risk related to the Brussels effect. Thank you so much.